Let's get more on what we should be expecting at the Open with Evan Lucas from IG in Melbourne. Evan, thanks so much for your time. Let's start with the market at the Open today because, boy, those spies are looking pretty heavy at the moment. Is this all about that US lead?
It certainly seems to be the case, Kate. Look, there's a lot of confusion coming out of the US. There's a lot of sort of questions being asked about the jobs market. Last night there was very interesting data that created a lot more sort of inconclusive data rather than anything else, and that really pushed the Dow and also the S&P lower, and that's why our futures currently look like matching down as far as 55 points. I think you may actually find us dropping into the 47s today, about 47.80, and it comes with the fact that the ADP Non-Farm payroll out last night was well below consensus at 135,000. Most people were expecting 171. We also saw inside the PMI data that was good data, the actual employment gauge in there, that also being quite soft, and that also basically started to asking the questions, are the US really on the right footing? Are they moving in the right direction? Despite the fact that we keep seeing officials, particularly some of the southern officials, we saw last night that the Dallas Fed basically saying that the movement in the US bond market is over. They're looking at that 30-year holiday they've had to be pulling back as they do wind down. So confusing data. And then we saw that the beige book out last night actually had a little bit of optimism. We saw gains in the auto sales area. We also see real estate on the way up, bank lending, and it also showed that hiring in some of the major districts was also up. So a whole heap of confusion. It just creates a lot of volatility. It again gets back to the question about when will the FOMC members start talking about actually tapering from the Fed, and that all led to basically really big down days in the US, and that unfortunately is going to flow onto our market today.
Evan, what happened to the bad news will be good news on the employment front, because it'll mean that the Fed will put off any tapering of that bond buying program, because that wasn't the case overnight.
Yeah, and that's also the interesting thing. Particularly the last 3 or 4 weeks, bad news has been good news. The short-sightedness of the market has also been a real reason why we've seen basically the market popping up on any bad news, because it means the tapering isn't going to happen anytime soon. I think the issue is the fact that they weren't sure which data to take. The ADP data is like a flash data, and it does mean that heading into the data tomorrow night our time for the official non-farm payroll and actually the unemployment rate may actually be revised down, and that obviously could see that if it does pop up on that bad data read. So it's all about where most people are positioning. You've also got to look at the fact that the Dow and the S&P did hit record highs about 4 weeks ago. It's only about a 2 to 3% correction, and it may also be profit taking and using this as an excuse, but it's the fact that a lot of white noise is coming through from macro data. It's very inconclusive. It's very hard to get a read on it, and that just creates volatility, and the markets hate volatility despite what's going on in terms of any liquidity funding, and that's probably also what's seeing that. The VIX index is now up 45% in about the last 7 days. It's sitting above 17, and that also will not be really good news for markets as a trading whole.
Evan, commodities overnight, we saw them, gold for example, pushing up. That perhaps no surprise with what happened with that jobs read, but also copper up, iron ore holding at about 116 a tonne. What's happening here when equities were on the slide?
Yeah, and again, gets back to that supply and demand idea. I think when we take gold first, gold's got an interesting situation going on it as well. As you explained, the volatility from the jobs puts the paper trade up, obviously on the way up. It looks at a safe haven. But the physical market's also quite interesting at the moment. Last night it came out that India, the second largest consumer of physical gold, is actually putting a cap on the amount of gold coming into the country. That'll also cause the price to go up as they basically constrain supply. Looking at copper, copper's also got supply issues. There is mining slippages. We've seen obviously in the US and also Canada some big issues with supply movements there from production. We're also seeing that across the Asian region as well, and that's why LME copper anyway is up to $7,480 a tonne. Iron ore, it's in the same position. The fact that it's slipped almost 30% in the last 4 or 5 weeks, it means that there is a bit of a splurge in demand, considering that the price is so low. There is rumours that China is well and truly picking that up. And yesterday we saw the Port Hedland export data come out. It was well and truly a nice beat. It was up about 7.1%. And exports to China were up 21.1% from Port Hedland from the month before. And it actually made up 83% of their exports. So that's where the iron ore is going. It certainly suggests that China is snapping up at these cheaper prices. And it is actually holding that high. And it may be why BHP's ADR is only matching down about 4 cents. I think it'll probably fall harder than that. There'll be a bit of a blanket sell-off today, but 33.75 is where BHP looks like it's currently sitting from the ADR market, and that actually puts a bit of support. So that fall that we're seeing does suggest that that yield trade is drying up and drying up fast. Unfortunately, you'll probably see you'll see the banks being probably the hardest hit, along with your Telstras, your Wesfarmers and your Woolies being the ones under pressure today.
Okay, interesting, but those commodity prices not enough to hold up the Aussie overnight, sitting at 95.38. I guess this had to be more of a story about the greenback than what was happening with the Aussie, because there doesn't seem to be any clear reason that it should have been sold off other than perhaps risk aversion.
Yeah, that's part of it. I think also if you have a look at the GDP numbers, they weren't fantastic, particularly Western Australia. And again, there's a lot of investment banks now calling for possibly 2 interest rate cuts before the end of November. Goldman Sachs there is the main one. So that's also put pressure on the Aussie dollar. Okay,
Evan Lucas, thanks so much for your time today. We do appreciate it. We will be looking at those defensives and the banks in particular today to see if we witness losses at the open.
Thanks, Kate.